that we love questions from the audience. So you can start commenting your questions now, or you can also add them as we go. I'll be right back on to welcome our guests to the show. Thanks for meeting us for coffee.
Good morning, everyone. Thank you so much for being here today. It's a great morning to talk about global energy markets and diesel fuel and all things trucking and really exciting topics that I'm actually not kidding. I think these are really exciting topics. So I don't need coffee for this conversation. I'm pumped up. But if you guys are joining us for the first time, thank you for being here. Usually we're on a cadence of every other Tuesday. Sometimes it's a little bit longer than that because I'm still navigating having a newborn around the house and all things, lots of kids and chaos. But we talk about freight markets. We talk about economics and where those two topics intersect and how that impacts the day-to-day decision-making for brokers, for carriers, for shippers, for you name it, any supply chain professionals. So love to have you guys here with us more often. You can just follow me on LinkedIn and you'll get my notifications for our future shows. You could also meet me in person and be a part of the Meet Me for Coffee podcast at Manifest Vegas in February. We've been talking about that since March, April, but now it's honestly getting close to the end of the year. So February is actually not that far away and it's time for your Q1 conference planning. So if you guys are looking to attend Manifest, the Future of Supply Chain in Las Vegas, please check it out. There's a link in the comments to this show. It goes to their website. You can look through it, see who speaks, what type of tracks there are, who it's for, who's going to be there, all the information you need to make an educated decision. If it's still not enough, shoot me a message, please. I would be happy to set up a quick call, answer any questions that you have. I just had a conversation with someone this week, actually, just kind of explaining here's more about the conference. They were asking questions, trying to determine ROI for their team, who should go. And I think that was a great way to help them decide if it's what's best for them. So feel free to use me as a resource. I've been, I think, all but 1 year since the show started. So you can also save $200 if you click the link in the comments to register. If you guys are going to Manifest, please let me know. I would love to know so that I can say hi and see you there. For anybody who's joining today, please say good morning, please. Matt and I would love to know who's listening in, where you guys are listening in from, what coffee you're drinking. I don't know. We just like to know you're here. We like to hear from you. So we'd appreciate you guys dropping a comment. My producer is going to throw that up on the screen so everybody knows you're here. And without further ado, I'm going to bring in our subject matter expert of the day and a returning guest, actually, to the Meet Me for Coffee podcast. Good morning, Matt. How are you doing?
Good morning, Samantha. Thanks for having me. I'm doing wonderful, and I'm glad that you're as energetic to talk about diesel and energy as I am.
Yes, I think that, I think a lot of things sound boring at face value in our industry, but, to those of us living and breathing it every day, I think we can make these conversations fun. You have been on the show before. It's been a little while. So for anybody who might not remember, would you mind introducing yourself and telling us a little bit more about who you are and what you do?
Sure, happy to. My name is Matt Muenster. Crazy German last name, so more of an I sound than a U sound. I'm the chief economist at Breakthrough. I've been part of this business for 12 years, really working at capacity providing insights and forecast guidance to shippers and focused upon sustainable fuel and transportation solutions. So I care a lot about the global energy market, ultimately what that means for not just diesel prices, but this growing portfolio of alternative energy that we're seeing roll out into the broader heavy duty landscape. But also care immensely about the broader freight market, especially dynamics that we're experiencing here in North America, but extending that to the global landscape as our business has grown. So, as I mentioned, I've been part of the business for 12 years. Really grew into this chief economist role as the business grew. In addition to Breakthrough, I'm very engaged with the National Association for Business Economics and lead its roundtable for transportation, logistics, and supply chain professionals. So just a shameless plug. If you're in an analyst role, you don't have to be an economist. You're in an analyst role, just care immensely about the data and statistics that matter to the industry. Do look up NABE. It's a wonderful association and something I've been very passionate about. And then in free time, I spend time volunteering for junior achievement and teaching financial literacy, work readiness, and entrepreneurship skills to youth. And also find myself figuring out how to coach a flag football team at present. So that's what keeps me busy with my 10-year-old son. I have an 8-year-old daughter and married and live in Green Bay, Wisconsin.
Awesome. Thank you so much for the introduction. I find myself trying to learn sports that I know nothing about because of my kids. And so we have 3 boys on the same tackle football team this year. And I'm like, look, I mean, I've always watched football. I appreciate football, but do I know it to this level? No. So I'm trying to learn. And then soccer was just I knew nothing about soccer going into that one. So I had to catch up. Well, thank you so much for being here. I appreciate the introduction. Would love to just kind of start off this conversation by asking you if you would kind of set the scene, if you will, and tell us a little bit more about give us kind of that high level overview of what's going on right now with global energy markets, and we'll go from there.
Yeah, happy to. So to really set the scene and how we've felt about 2026, coming into the year, dig up these couple of data points, but coming into the year, the Energy Information Administration, with its December release of its short-term energy outlook, was forecasting crude oil prices to be about $51 per barrel for 2026. At Breakthrough, we were forecasting them to be about $60 per barrel in 2026. Basically, both of us, slightly different figures, were expecting 2026 to ultimately be much of a repeat that we had in 2024 and 2025, moments in time when energy prices had returned to previous equilibrium and ultimately had not been front of mind because they had been stable and far less volatile than what they were back in 2022 and 2023. Well, that all rolled right out the window end of February, beginning of March. Obviously, we've had a massive geopolitical crisis and energy crisis for the second time in 4 years. It's the kind of shock that's really difficult to forecast because it's supply side. So it's kind of a dummy variable. It does or it doesn't happen. You could have different thresholds of risk embedded in the forecast, but ultimately you likely didn't have something to this extent. And we've got pressure not just on crude oil prices, which sit at about $85 today versus that 60 or 50 to 60 range that we had forecast at the beginning of the year. But we've got a lot of pressure on specific energy types or specific refined products that are derived from that barrel of crude oil, particularly low sulfur fuels. And that's where this conversation has really become probably the first talking point that we're having at Breakthrough with shippers all through 2026, even in a really elevated freight rate environment, because it's this trying to grasp what's happening to low sulfur fuels internationally, why are energy costs so high, and why is this most significant variable cost in the movement of my goods to market as high and as difficult to forecast as it is. And so that's really a little bit of the landscape. What's driving it, of course, the closure in the Strait of Hormuz, but it's become much more broad than that. That's the primary bottleneck in scope. But it's not just energy being unable to leave the Persian Gulf. That's a challenge. It's energy flow through the Red Sea. That's also a challenge. You're hearing about another bottleneck, the Bab el-Mandeb Strait being closed. Traffic, of course, through Suez has been limited for years. We haven't seen international maritime traffic return to its norm following initial conflict in the region. And so ultimately, this has been very profound. There have been very profound implications for international shipping and international logistics for energy products.
Thank you for that. I would like to I think I have to follow that up by asking, what is the outlook right now? Right. I mean, I think at first we had so much back and forth and the headlines around, we're going to open the strait, we're going to, reopen, it's closed, it's reopened. I think we're weary of that. But at this point, what does it look like? And are we reached a point where things have just fundamentally changed with global energy markets, I guess specifically the distribution of oil?
At Breakthrough, we forecast 24 months. I would say we're to a point in which that 24-month forecast has fundamentally changed from the beginning of the year. So the full length of the curve has fundamentally changed from where we started 2026. So we're at that point in the ongoing conflict and energy crisis. I'd say there are a lot of indicators we can look at to get a grasp of what's happening in energy markets and that we do to forecast. What's unique in 2026 is probably the most important indicator to stare at. And it's difficult to do for a couple of reasons. I'll get to that in a moment. But the most important indicator is the flow of tankers and vessels through that Strait of Hormuz. The International Monetary Fund has a great website in which is publicly available data, and you can do this. And ultimately, if you were to plot the trend of vessel flows through the Strait of Hormuz, and also plot the price of crude oil over the same time frame, you'd see there's a very strong negative correlation. So as the vessel flows come down, the oil price pops, and vice versa. And ultimately, that's what's driving that crude oil price. It's also driving refined product price. And so if you were to remove that crude oil price per barrel and ultimately replace like ultra low sulfur diesel prices or commodity price from New York Harbor, you'd see a very strong correlation of the same nature. And so in 2026, the most important indicator is the flow of vessels through that strait. In that respect, nothing has really changed.
Yeah.
We had a modest bump. The second half of June and July, things were looking better. Prices responded dramatically. We were back toward a $60 barrel of oil in what seemed like no time. But ultimately, we're right back. So the ceasefire has essentially lapsed. We really haven't seen too much action in terms of returning to a table. Seems like there's an announcement vessels are flowing through the Strait of Hormuz, although the volume is nowhere near pre-crisis level. So until that returns, I really think it's status quo. And ultimately, we've had a disrupted energy market, and our forecast in the next 24 months, really, regardless of product, are much higher than what they would have been to begin the year. And I certainly can elaborate on that.
Yeah. So it kind of seems like we're finding some type of new normal in, vessel flow, as well as that's kind of maybe a good way to summarize the stabilization that seems to be taking place right now in the U.S. domestic freight markets. Seems like kind of rates are kind of steadying out. We've kind of seen what I usually call like the dog days of summer. We're kind of in this lull where everything's starting to find like this new normal for at least a short period of time. Let's kind of shift from talking about oil and talking more specifically about like U.S. diesel markets. So how have we seen, all of this that's going on affect the price of diesel here? And more importantly, I guess, how does that impact trucking here in the U.S.?
Yeah. For trucking specifically, I'd like to do our best, and teammates are great about this, do our best to unnumb the numbers. So there are a couple important characteristics that really drive the volatility of that final price per gallon that you're paying at the pump when it comes to diesel. So often we go headline figure, which is crude oil, it'll continue to be crude oil, but I've thankfully have and others in the industry have had a chance to contribute to places like Wall Street Journal, and more they're coming around to shift their focus onto that price of a gallon of diesel. So we'll keep fighting that fight. When it comes to the underlying diesel buildup, in normal times, if we're breaking this down in percentage terms, about half of that diesel price is typically driven by the underlying cost of crude oil. About 25% is driven by a refining crack or premium for diesel as a unique refined product that's being produced or really manufactured from that barrel of crude oil. So crude oil is the input to the refinery. Diesel, gasoline, jet fuel, bunker fuels are the output. And in that process, we're adding about 25% of that final diesel cost buildup, and that's diesel's premium. Then about 15% is tax. Can't do a whole lot about that. As much as we might try. And then there's some distribution, transportation costs, and ultimately there is a margin between retail and wholesale prices. What has flipped tremendously, you look at recent trading prices to help see this, and we can show the difference between where these parts of the price buildup existed back in January 1st and where they sit today in August, middle of August. And ultimately we've moved from price of a barrel of oil in the beginning of the year about $60 to one about $85. Every dollar of change in that underlying barrel of crude oil adds about 2.5 cents, either adds or subtracts about 2.5 cents to that final cost of a gallon of diesel. But so does the diesel refining crack. And that's also expressed in commodity trading in dollars per barrel. So we need to do a little conversion to get there. Right now, as we sit on August 18th and stare at commodities futures that are live, the price of a barrel of oil is trading about $85. The diesel crack is trading at about $100 for the front month, which really represents the best price of what we can expect to make and influence the wholesale markets for diesel tomorrow. And so I explained before, in typical markets, crude oil makes up the largest and most volatile portion of that price of a gallon of diesel. Well, that's not true right now. Right now, it's the refining premium for diesel as a unique commodity. And so part of this whole experience is really coaching firms, shippers, carriers, brokers, whoever needs an energy forecast to think about their financials and ultimately understand how they're making out revenue and expense-wise, to start bringing your focus off of that barrel of crude oil and bring much more focused intention, due diligence onto those particular product cracks, whether it's gasoline, diesel, jet fuel, bunker fuel, because that's what's really driving volatility right now. And it's that way for a couple of reasons. Diesel structurally has been tight going back really to the pandemic. There we had gasoline demand destroyed in a significant way. Some of it never came back just because we've had much larger remote workforce. We'd have different gasoline demand had the event never taken place. But we know in freight markets and the freight rate experience and demand experience and consumer shift to goods that diesel demand was really robust. And so we had this imbalanced experience. We had refinery utilization that had slumped because they just didn't have the demand for gasoline. However, they still needed the diesel. And really from that moment on, diesel has been fighting a structurally tight battle. You lump in the Russia-Ukraine war, and Ukraine as of late is having a lot of success damaging and destroying Russian energy infrastructure to the point in which Russia just in the last couple of months has halted diesel exports, which is very weird because it's typically a very significant supplier of diesel in the international market. And then you lump in the fact that now we have international choke points that aren't allowing those producers getting diesel in the market. And we really have an exceptionally tight market. And so inventories for diesel are low. Yeah.
Is it difficult to bring on additional refining capacity for diesel?
Very. Yeah, there's been, while there's some investments happening at existing refineries to maximize diesel yields. Refineries are massive chemistry sets. They ultimately run best if the input to that chemistry set is consistent. So when there is international disruption to crude oil markets, there's all sorts of different traits that exist within crude oil based upon where we're pulling it from the ground. So as that is logistically disrupted and different types of crude oil need to make their way to different refineries, all of those yields get impacted. And so while in the US, we really haven't had massive refining capacity additions in decades. We just haven't. We've seen the opposite. We've had a couple of closures in California as of late. We have other instances back in May where there was an electric outage at a refinery in the greater Chicago area in Indiana. It took 440,000 barrels out of the market. And in 3 business days' time, the price of diesel in the broader Chicago market was up $1. So we tend to fight capacity. Right now, they're being heavily utilized as we expect through summer. They're running at about 96 or 97%, which is basically peak utilization in the United States. We tend to see this fall off as we enter fall, which creates some additional risk for upside pressure on the diesel prices. Although given the current margin they're receiving and how profitable they've announced that they were in recent earnings, they're going to do their best to maintain that utilization because life is good as a refiner right now.
Do we refine 100% of the diesel that's consumed here in the U.S.
There will energy is an international market, and so regionally across the U.S., we will be importing and exporting where economically it makes the most sense. Right now, we're exporting about 2 million barrels of diesel a day, just under that, which is an all-time high also. And this is bringing a lot of stress into the market. It's going places like Latin America, Europe, further abroad in Asia, markets that typically it wouldn't, but given circumstances and the tightness in the Middle East, it has to. We're really the swing supplier for diesel right now, but our own market's tight.
Yeah. And what about crude? Do you have any numbers on how much we're like importing versus exporting?
So the U.S. still has demands to import. We're about a 20 million barrel per day consumer of energy products. We're producing, I believe, just shy of about 14 million barrels per day of crude oil. And so we still need to import crude oil. We do our fair share of exporting, though, too, ever since that ban was lifted going back to 2015. That's gradually ramped up over time. And again, energy is an international market wherever those economics make sense. Like it's far easier to ship crude oil out of our Gulf and perhaps bring it into West Coast refineries from elsewhere than perhaps ship it from the U.S. Gulf Coast and ultimately West Texas production through the Panama Canal to West Coast markets. It can be easier for them to get their crude oil from the Middle East, for example, or more efficient for them to do so. And so we see that fluctuate from time to time in terms of regionally where we're pulling crude oil for refineries in the United States. That's also been something that's been disrupted internationally for years, going back to Russia, Ukraine, and ultimately Europe's decision to basically move on from Russian energy products, or at least the European Union countries, by and large, moving on from Russian energy products. And we've kind of been in this logistical energy scramble now for a couple of years.
Yeah. I had someone ask me about the health of our, I guess, energy partnership with Canada. Do you have any insights there? I mean, everybody knows that tensions got pretty hot between Canada and the U.S. But we have had quite an established, partnership when it comes to energy products. So have we seen any disruption to that through any of these kind of like geopolitical like tensions, or has that remained steady?
Yeah, there's a lot of political tension for different reasons. We can all appreciate the policy shift from basically progressive and lower carbon energy sources through the Biden administration that were in focus to conventional energy focus and fossil fuel focus. It's been part of the Trump administration. Both countries want to see their domestic energy industries grow. Both countries want to achieve greater domestic energy independence. So I think those kind of underlying principles still exist, but throw in tariffs and other trade kind of as collateral damage into the political relationship, and it is tense. I do think as a outcome of the last 2 energy crises, we will see and are seeing reinvigorated appetite for pipeline growth to move products between countries. But as you mentioned, the political relationship is the wild card here. And obviously, it's going to continue to shuffle, even with midterms around the corner. So every 2 years, it might feel different.
Yeah. Well, thank you for that. I want to talk a little bit about broader freight markets as well. Breakthrough sits in a very unique position to be able to be involved with so many shippers and private fleets and their, for hire logistics. And you guys have a great, seat at the table, if you will, in understanding the dynamics of the freight market. So of course, when I asked, I mentioned earlier kind of feeling this stability, it seems to kind of be setting in right now. But would love to know what your take is on where we stand right now in the broader freight market as far as volumes or rates or capacity. Just any thoughts would be welcome.
Yeah, and I'll share this. I dig into some of our own data and insights. We work with more than 300 shippers of really all shapes and sizes across a host of industries, tend to have data and information that correlates really well with the broader experience in the economy. It doesn't represent the whole economy. And so there might be parts of the things that I'm speaking about that could feel different to the audience. And that could be a nuance. But general experience that we're having in 2026 there's a lot of pressure on the shippers. Obviously, we've covered the energy market side and the volatility of that variable cost for transportation. But we're experiencing a tremendous amount of pressure, have since really the second half of Q4 last year under those spot and contract rates, the movement of truckload freight, especially throughout North America and abroad for that matter. We see similar patterns of just structural price pressure elsewhere. And it's being driven by, just like the energy market, major supply constraints. And internationally, it can feel a little different. Here in the United States, when it comes to the truckload market, there are a number of different factors. It was years-long slump in rates. And ultimately, we've seen the underlying cost of operate gradually increase year over year. It's the cost of labor. It's the cost of equipment. I mentioned tariffs earlier. That's having implications on, say, the cost of aluminum on trailers. It's insurance costs. It's a host of these additional costs that continue to have inflationary pressure. Ultimately, it reached a point where we're seeing a lot of attrition in existing fleets. So I really think it's financial pressures that have weaned fleets over that timeline moving 2023 through 2025. But then the policy environment is dramatically changed. So we can talk English language proficiency, and it's especially the implications of it regionally along both the Canadian as well as Mexican borders. It's the presence of non-domiciled drivers in the market and the crackdown on ensuring that all drivers are first safe and legally eligible to operate in the United States. But these things have factored in the capacity experience. That's tightened the market across demand in our ecosystem. We look at freight volumes. We had a recent summertime pop in paper and packaging and retail, really attributed it to front loading and an early peak season and continue resilience from consumers, their purchasing of those products. We've had imbalance elsewhere. Consumer packaged goods volumes have been down. Durable goods volumes have been down. There's a mix of factors here, from interest rates and cost of housing all the way to GLP-1s and ultimately the change in our grocery carts. But when we bring all of those things together, tonnage is basically flat. And we see it in nationally published truck tonnage figures. But when we look across our ecosystem and look at total North American volumes for the truckload and intermodal market, they're pretty much flat, slightly up, slightly down at different periods of 2026 year over year. And so we really have this supply-driven market, and both when it comes to freight rates as well as the energy that powers it, it's the supply side that's causing us headaches in 2026.
Absolutely, yeah. I would like to also ask you, also first, I had a thought. If you guys want to be on like the cutting leading edge of knowing what might happen in freight markets, listen to this podcast, because it was almost 2 years ago that GLP-1s got brought up as a demand constraint possibility. And we all had a good laugh about it on the podcast at the time. It was on a panel. And then, I mean, by golly, if I don't think it was right. So here we are 2 years later, still talking GLP-1s in a much more real sense.
A two-year topic on the capacity side that I think can be greater is autonomous vehicles. Yeah, I don't think we're talking about them enough, but I'll just throw that out there. And hopefully 2 years from now, there's more to talk about.
I think that is an excellent point, actually. And I would also say that this year has been huge for setting the stage for autonomous vehicles. And I mean, correct me if I'm wrong, but the just energy prices for one, and then two, just the difficulty that fleets are having right now hiring drivers, like finding strong drivers, retaining those drivers. I heard recently that the churn rate for drivers at one of the nation's largest fleets is almost 100%. And so like just the strain that goes into trying to operate these large fleets from an employment standpoint, to me just points to autonomous as a strong future option. So I think we've had a lot of headwinds facing, fleet management. And I think that a lot of those headwinds lend very nicely to making autonomous a very attractive option in the future. Yeah. And electric as well, too. Like I think electric kind of died off for a while, but I think the more, concern we have around fuel, potentially, the more we could see that conversation come back as well.
Yeah, I agree. And while Breakthrough's been known for a long time for our work with shippers and management of energy between shippers and carriers partners, we've become much more invested in with fleets in energy management solutions, and also working solutions in terms of network efficiency, fuel management for really anyone operating equipment. And I'd say that certainly stands up in terms of conversations that we're having with them. Then also just something that has existed and been present with that retention of labor and ultimately turnover is your ability to ensure that your driver pool maintains best practices in energy management, especially with where we sit in 2026. So even though you have fuel card discounts, whether or not your drivers are compliant with them is a whole nother conversation, as well as whether or not you're truly receiving the best value from that discount. You go to audit it and ensure that you're receiving it through your financials is also, not a given in this climate. But you're right. The driver turnover creates a lot of issues downstream of it. Fuel use and card use being one of them.
Yeah, absolutely. All right. Well, I would like to ask, we're at 33 minutes. We can keep going for a little bit. I never stick right on time on 30 minutes. How have you guys seen the kind of changes in, the truckload environment impact how we're having conversations with our partners? So how are we having sourcing efforts, our RFPs? Have we kind of seen this is the first time I can remember in a long time that like we're responding so quickly and almost in real time to price changes, because I expected things to, get renegotiated as the rates rose. Mm-hmm. But now that we're seeing this, what I call this brief lull, I'm hearing from carriers and from brokers that, everyone's already coming back saying, hey, rates are going down a little bit. Like and that's just something we didn't used to do. We didn't used to go and like pump the brakes the second rates started to pause or even go down a little bit. But we used to have these 12-month, 6-month conversations where, if you're going to hold a rate for 12 months, you're going to win some, you're going to lose some, and you had to find that balance. But now I'm curious what's happening in this environment if we're saying like, hey, every time rate environments change, we're going to the table to renegotiate. Are we at a point where we can move faster now in like loading in rates, responding to what's happening in the market? I would love to hear from you guys what you see those conversations looking like.
I think technology has certainly enabled that. And just that's the difference cycle to cycle is how much more advanced we can pursue different rates in near real time and understand what's happening in the environment in near real time. I would say by and large through the shipper experience, 2026 has been different for a number of reasons. But first, compared to past years, your primary tender acceptance is vastly different than what it was over the last couple of years. The last couple of years, you could take 98% almost for granted, and there might be a couple of blips that keep you off of perfect tender acceptance just based with where rates were. Much more challenging market to find capacity in 2026. You saw that dip and ultimately go into like mid 80% territory within our ecosystem, still holding better than we see in the broader market, but ultimately very challenged. It's rebounded off of that as we've gone through many RFPs in the second quarter, and ultimately we have seen more stability with rates as those new contract rates have come into fruition. Still a lot of volatility in the market. We're going to have another event in a week's time, International Brake Check, that's been highlighted. Probably would have been an afterthought in most years, but after International Road Check earlier this year and the weeks of upward price pressure and volatility it brought, I don't think we can discount it as far. I still think there'll be volatility and pressure onto rates given where costs exist for the broader industry. And like we've talked about, capacity tightness. We're seeing some green shoots in total number of firms operating. We're seeing some green shoots in the labor market with drivers returning to the market, but very slow and probably counterbalanced by some non-domicile drivers continue to be removed from service. And so while there might be some shippers, interested in chasing rates, I think just by and large, we continue to see much of our shipper base and ecosystem stick to their RFP plans, focus upon running the events well. It's taking more work to achieve their goals. Really double down on getting to know their carrier partners, given all the circumstances that are happening in the policy landscape, as well as fraud and other things we need to unfortunately think about when contracting. But really doubling down on the right fits for their network. How efficiently can that freight move to market? We're seeing more and more shippers use smart waste scores as a direct input into their RFP. And ultimately, they want to continue to progress on their journey to decarbonization, even though it's a challenging environment cost-wise. And so all this factors into it. But I think we still see that following a consistent RFP plan, adjusting strategy to the data and information at your fingertips still wins the end of the day. And yes, relationships also matter. But there have been a exceptional focus on data and information and network fit in 2026.
Thank you. I appreciate those insights. Also, I think I find it interesting that we're still I was interested to see how the attitude might shift around decarbonization efforts with kind of the overall administration's attitude towards that. But it's interesting to hear that a lot of companies have chosen to still, prioritize that. There was a period in time, certainly, where smart waste scores were like very important and necessary. And I didn't know if that had at all lessened in the last few years.
Well, just to throw some dollars against it. So natural gas, compressed natural gas, and Cummins has a new power unit in the market. It can serve as a natural hedge to what we're experiencing in diesel prices. So if you look at compressed natural gas costs, and really the focus is renewable natural gas because of the difference in emissions intensity. But you look at those prices over the last year versus diesel prices, they don't have the upward volatility that diesel prices have had. And so the next closest thing to a paper hedge is the consumption of natural gas, and it's coming with significant savings for those that have deployed it in the last calendar year, of course, in the current environment. We still see electric trucks roll out. There's a lot of impressions on the Tesla performance. We're seeing it on LinkedIn, obviously.
Yeah.
And then beyond that, though, when we talk about smart waste scores, the difference in efficiency for the top tier smart waste score to a score 5 or unranked carrier is nearly 2 miles per gallon. And so you think about what that would mean to your reimbursement of energy in 2026. Avoiding those additional gallons is huge, well, especially when they're $5.50 wholesale.
Well, Matt, to close today out, I would like to ask for like a short list, and you don't have to explain these too much, but if you were to rattle off a few things that you think could be potential headwinds for diesel or just energy markets in general. I'd like to hear that. And then also any like final closing advice that you might have for our listeners today.
Sure. I'd say for any diesel consumers, it's a really important time of the year to pay attention to it. Unfortunately, I think price pressure is here to stay, especially through October and November when we have agricultural demand and freight demand overlapping, as well as some of those refinery utilization levels decreasing. So we unfortunately still see price pressure happening. Beyond that, it's the straight and a return to normal, hopefully geopolitical relations that'll help us progress. And you think we have a chance to catch up a little bit over the holiday season when there tends to be less diesel demand as long as refineries keep up. So unfortunately, I think we're into 2027 before we see price improvements on the diesel side. Sorry, your second follow-up question, if you could just remind me.
Any advice for our listeners?
So make sure you don't just focus off the barrel of crude oil. It just isn't going to serve you very well when it comes to energy products right now. The other advice is be open-minded about the indicators that you're using in your forecast. In 2026, it's the supply side of the market that's really caught us flat-footed, both with the international energy shock and then within the freight transportation industry, the impact of policy onto labor. 27 will be a new experience. So ensure your data set doesn't stay stale for too long and you're incorporating new sources, new perspectives all the time. It's great reason to get to Manifest. It's a great reason to be on LinkedIn. Keep broadening your perspective.
Yeah, absolutely, man. So just since I've started this podcast, it's like there's been so much that's happened. And we've had to start looking at so many different, sources and each month now to kind of gauge where we're headed and what the implications could be for freight markets. So yeah, I think I've been doing this podcast for a little over 2 years. It's like, how are you still talking about freight markets and economics? Well, because lucky us, it's changed a little bit every few months and like what we need to be talking about to understand them. So
yeah, never a dull moment. I love it.
At this point. So, well, thank you so much for being here. I know that you have an active presence on LinkedIn. So if anybody would like to connect with Matt, ask any questions, learn more about the work he's doing, learn more about Breakthrough, please go follow him on LinkedIn or send him a message on LinkedIn. You guys can also comment your questions on the LinkedIn Live event. So maybe you're listening back to this on Spotify or Apple Podcasts. Just go look me up, Samantha Jones, on LinkedIn and find this show. It'll be right at the top of my profile. You guys can drop in a question. You can tag Matt. You can tag myself. Let us know what you guys have questions about, and we'll get to those when we can. Or again, reach out to one of us directly. We hope to see you guys all at Manifest in Las Vegas in February. But until then, Matt, thank you for being on the show today. Really appreciated having you.
Thank you so much, Samantha. My pleasure.
Absolutely. And thanks everyone for listening in today. We're glad you were able to meet us for coffee.